Hello everyone, hope you have a nice day and welcome to my new blog. So today our topic is dividend policy. So as we all know that dividend refers to that portion of profit after tax which is distributed among the owners or shareholders of the firms. The finance manager has to take few decisions which are interrelated like investment, financing and dividend decisions also. So dividend decisions is related to the shareholders expectations from the shareholders share in the profits of the company. So the focus of the dividend decision is on the dividend paid to the equity shareholders. As preference, shareholders are entitled to a fixed rate of dividend. Now, dividend policy determines the amount of earning to the distributed amongst the shareholders and the amount of earning to be retained. Retained earning are that portions of the earning which is to be plugged back in the firms as reinvestment. So dividend policy refers to the policy chalked out by the firms regarding the amount they would pay to their shareholders as dividend. Once firms make profits, have to decide on what to do with these profits. So dividend policy of a company is the strategy followed by the decisions, the amount of dividends and the timing of the payments also. Now there are various factors that frame a dividend policy of the company according to a Western and a Brigham dividend policy determines the divisions of earning between payment to shareholders and retained earning also. Now, dividend policy, its overview. Now we discuss about this. So, the what is a dividend policy? First of all, we know that its meaning, definition, objectives, types of dividend policy, significance, forms, theories, factors, approaches, stable dividend policy, and more. So, dividend policy and overview, we discuss about this. A question arises before the management of a company that what should be its dividend policy and what should be the considerations before the dividend is declared. So one thing is sure that the shareholders have a preference for cash dividend or and it is necessary to meet their expectations. So they are not satisfied by a promises of capital gains because a bird in hand is better than two in the bush. So secondly, dividend is an important signaling device. Now since most of the shareholders do not understand accounting concepts like book value, per share, return and equity, earning per share, etc., they tend to measure a company's performance in terms of dividend distributed by it. A company giving high dividend is perceived to the performing well and non or low dividend paying company is perceived to be a non-performer or performer. A company which is consistently increasing its dividend payment is considered to the growing company and vice versa. Under this situation, it is essential for a company to pay some dividend to its shareholder also. The only consideration before them is to decide how much dividend should be paid for the given year. So in these decisions to pay dividend to its shareholders, a company should therefore consider the following points. Now we discuss about this. The first thing is to consider the relationship between R and K. If R and K, low dividend should be recommended and vice versa if R lower than K. The second point to consider in deciding a dividend payment is to look to funds available. So dividend payment or dividend payment entails an immediate payment of cash, and if the fund's position is tight, then it is not advisable to give a high dividend. Now similarly, if huge idle funds are available anytime during a year, a company's management may consider payment of an interim dividend based on its assessment of profit for the year. This relieves the pressure of the company to pay a dividend after the accounting year is over. Another consideration before a company is to look at the availability of funds from outside. In funds from the outside and are not available, then the company has to entirely depends on its internal accruals to meet the requirements of funds. In such a situation, payment of dividend may be avoided to conserve its financial resources also. If, on the other hand, a company can have easy resource or recourse to fund from outside, it may be liberal to giving dividends because any requirements of funds can be easily made by borrowing. Now, taxation of dividends is also a consideration in deciding the dividend policy. It may countries dividends are taxed in the hands of shareholders also. This reduces after tax returns to them. In such a situation, companies may give returns to the shareholders in the form of bonuses, shares on share buyback. Both these methods give a capital gain in the hands of shareholders also, which are taxed at a lower rate rather than income which entail a higher tax rate. In India, under the present tax laws, dividends are tax free in the hands of shareholders, but the company is required to pay a dividend distribution tax (DDT), which creates a wedge between burden to the company and the returns of the shareholders. This DDT is a disincentive to a company to pay a high dividend to the shareholders also. Before declaring a dividend, a company management has to consider whether they will be able to maintain the dividend in future also. If a high dividend is followed by a low dividend in future, it is considered a poor reflection on the working of a company that has an adverse impact on the market price of the share. So it is therefore considered better to be conservative, that is, give a low but continuous growing dividend to the shareholders also. It is also necessary to look at the preference of the shareholder. Do the shareholder prefer cash dividend or do they prefer capital gains? If they prefer cash dividend, then the management should adopt a high dividend policy. If they prefer capital gains, then it is better to follow a low dividend policy also. Age profile of the shareholders also has an impact on the preference of the shareholders. If the majority of the shareholders are young, they would have a natural preference for growth rather than immediate cash dividend. If they are old, they would have a natural preference for cash dividend rather than growth in future. So the dividend policy is a company should take into considerations these factors also. There are certain statutory rules and regulations which the governments make with regards to transfer of a portions of the profit, statutory and other rewards for paying dividends. Similarly, a government often have MOU with some statutory entities and government corporations. It is necessary to adhere these regulations in making dividend decisions also. Now, dividend policy. Dividend refers to that portion of the profit tax after tax which is distributed among the owner of the shareholders in the firm. We earlier discussed about this. So dividend policy determines the amount of earning to be distributed among the shareholders and among the earning to be retained. So retained earning are that portions of the earning which is to be plugged back in the firms as reinvestment. So dividend is important to equity shareholders as it increases their current income. Thus, the crucial issues of financial management is how the earning of the firm should be divided between retention in the firms and payment to the owners. So dividend and distributed out of the profits earned by the company, cash inflow generated by the business are used for payment of dividend its equity shareholders. Divided payment is a cash outflow. Dividend are priority cash payments by the company to its shareholder also. So dividend payment is to equity shareholders are made after making fixed financial payment like interest on debt and dividend on preference shares. To distribute the dividends, company must earn profits. Always remember that. So alternative to the distributions of the dividend is retained earning or retention of profits. The choice between payment of dividend and retained earning depends on the effects of these decisions on the maximizations of the shareholders' wealth. So if the decisions to pay the dividend maximizes the wealth of the owners, then the firm should pay the dividend to its shareholders. If dividend payment does not maximize the wealth of the owners, then firms should retain the earnings and invest these funds in the projects where maximum returns can be gained. A company can declare the dividend in its general body meeting as per the rate recommended by the board of the director. Further, the dividend can be interim or final. Board or director can pay interim dividend before finalizations of accounts if they expect sufficient profit in a particular year. Dividend can also be paid in the form of stock, that is bonus shares also. Now, dividend policy meaning of dividend. The term dividend refers to that part of the profit after tax which I discussed about this and which is distributed among the owners and the shareholders of the firms. In other words, so dividend are usually given as cash dividend, but they can also take the form of stock dividend also or other property. So dividends provides an incentive to own stock in the stable firms even if they are not experiencing much growth. Firms are not required to pay dividends. So the firm that offers dividend are most often firms have progressed beyond the growth phase and no longer benefit sufficiently by reinvesting their profits. So they usually choose to pay them out of their shareholders, also called payout. Now, dividend policy. Dividend may be defined as divisible profit distributed amongst the members of the company in portion of their shares in which such a manner as is prescribed by the memorandum and articles and association of the company also. And dividend policy refers to the policy chalked out by the firms regarding the amount of they should pay for their shareholders as divided. Once firms make profit, they have to decide on what to do with this profit also. The firms have two options with them. They can retain these profits within the firm. They can pay these profits in the form of dividends to their shareholders. So the dividend policy to be adopted by the firms is based on these two options. If the firms pay dividend, it affects the cash flow positions of the firms but earn goodwill amongst the investors who therefore may be willing to provide additional funds for the financing of investment plans of the firms. On the other hand, the profits which are not distributed as individual or dividends become an easily available source of funds at no explicit cost. However, in the case of plugging back of profits, the firms may lose the goodwill and confidence of the investors may also be defy the standards set by other firms. Therefore, in taking the dividend policy, the finance manager has to strike a balance between distribution and retention. He should allocate the earning between dividends and retained earning in such a way that the value of the firm, that is wealth of shareholders, is maximized. Thanks a lot for watching my videos. Please subscribe my channel. It's my humble request. I need your support, my friends. Thanks a lot for watching.